Hi, welcome back to Father and Son Investing. All of us will face emergencies. It is just a fact of life. However, if you are prepared, facing those emergencies can feel much less stressful. What type of emergencies am I talking about? I'm talking about job loss. I'm talking about medical or dental emergencies. How about unexpected home repairs or car trouble? How about unexpected travel expenses, such as when a relative passes away? All of these can tax our financial situations if we're not prepared for it. Did you know that more than half of Americans can't pay for a $1,000 emergency without tapping their credit cards? Today, I'm going to give you 3 quick reasons why you should have an emergency fund, and then we're going to talk about 3 places where you can keep those emergency funds. Let's talk about 3 quick reasons to have an emergency fund. This is certainly not a comprehensive list. However, the first one, I think, has to do with your own mental well-being. The amount of stress that you will feel in your life if you have some funds set aside for an emergency is going to go way down. The confidence that you're going to feel in your ability to have an emergency is going to go up. The second reason to have an emergency fund is to keep you from spending money on a whim. I'm talking about an account that is set aside from your day-to-day finances and is devoted to emergencies. That will keep you from spending this money on a sale that you see, such as a big screen TV or a nice stereo, or from just using it for day-to-day expenses such as buying a cup of coffee or lunch with colleagues. A third reason to have emergency money set aside is to keep you from making bad financial decisions. Sure, you can access emergency funds by tapping your credit card or applying for a loan at a bank, but those come with fees and interest, all limiting your ability to continually increase your emergency funding in the future. So there's just 3 quick reasons for an emergency fund. Now, I want to talk then about where are the best places to keep your emergency funds. 2 things you'll not hear me talk about in this video are going to be CDs, and that has to do with liquidity. CDs are not liquid. And your Roth IRA. While you can tap your Roth IRA funds without fees, it generally is just not a good idea to be tapping those because those funds are set aside for your retirement, not for emergency fund. So I would call a Roth IRA a dire emergency fund, and that's about the only reason to tap into that. In this video, I'm going to give you my favorite 3 places to keep your emergency funds, and those are high yield savings accounts, Treasury bills, and a money market account. We're going to fill in each of these based on the interest rate, the liquidity, the safety, the risk, any minimum balances that might be required, and access to your funds. So let's get started. One of my favorite places to keep emergency funds is a high yield savings account. In fact, this is really what got me excited about keeping an emergency fund. When I finally found an account that yielded something better than the 0.01% that I was receiving from my bank, I got excited about seeing those interest payments come each month. So let's talk about high yield savings accounts. Interest rate, right now high yield savings accounts are yielding some fantastic interest rates. You have to shop around for them. For instance, if you go to Blue Peak, you can get 5.33%. The high yield savings account I have had for years now is a Marcus account. Yes, it is yielding less than what the maximum is that I could be receiving, but one of the things about these high yield savings accounts are that the interest rates change and vary from bank to bank from time to time. You could find yourself chasing interest rates, having to open multiple different savings accounts and moving your money around multiple times. So I have opted just to keep mine at my Marcus account, which is currently at almost 4.2%. Let's talk about liquidity. You should be able to withdraw an emergency fund quickly. It might not be instantaneously, but you should be able to get your money within about 1 to 3 days if it's truly an emergency fund. You'll need to keep track of your banking institution's rules regarding liquidity. For instance, while you may be able to withdraw or deposit any time, there may be some limits on the number of withdrawals that you can make. Now, during the pandemic, those traditional 6 times per month were actually placed on hold, but many institutions may still have that traditional 6 times per month as one of their rules. So you'll want to check on that. And realize that it may require several days to get that money. So if you need to write a check to cover an emergency and you know that you won't have that money for a few days, Obviously, that's not a great idea. Let's talk about safety. High yield savings accounts are FDIC or NCUA insured, and that's up to that $250,000 per depositor per bank per account type. You'll want to look into that because there are ways that you, if you're combined with a spouse, or if you name individual beneficiaries on an account, there are ways to get more than just $250,000 worth of insurance at one institution using multiple accounts. Let's talk about risk. A high yield savings account is extremely low risk, and that is because it is FDIC or NCAU insured up to that $250,000. If you go above that $250,000, then obviously you are taking some risk. Let's talk about minimum balances. That varies. You may be able to have a minimum balance of 0 and still keep your account. Some accounts require you to have a minimum balance of up to $2,500 in order to get the high yield percentage. Otherwise, they drop you down to just their nominal percentage that they offer. Also, realize that fees may apply if you dip below that minimum balance. Lastly, let's just talk about access. Many high yield savings accounts offer ATM cards, but many do not. Some may offer checks on that high yield savings account, while many do not. And realize that some may be strictly online, like my Marcus account, while others may have a physical location where you can rapidly access the money. Next, let's talk about Treasury Bills. This is one of my favorite places actually to keep money, and a lot of that has to do with the yield that is available right now on Treasury Bills. Let's just talk about Treasury Bills. This is one of my favorite places for emergency funds and cash. Why is that? Well, that has to do with the yield that's available. You can get a 5.4% yield on a 4-week Treasury bill. Now realize that you are not going to get 5.4% in 4 weeks. This is an annualized rate, meaning that if you were to keep your money in Treasury bills for the whole year, 4-week Treasury bills, you would be getting approximately 5.4%. The highest yield right now on Treasury bills is 5.54% on a 26-week Treasury bill. That's about the best you're going to see on a very liquid asset. Why is it so liquid? Well, it's because there is an enormous secondary market for Treasury bills. You can sell a Treasury bill to anybody pretty much on any given day. Realize that there can be some settlement time in there, so the liquidity might not be instant for you. For instance, I've had a Treasury bill at Vanguard, and therefore, if I needed to sell that Treasury bill, I would have to tell Vanguard to sell my Treasury bill. They would then find a buyer, and then it would take some time to settle that account. But realize that typically that's going to be in 1 to 3 days. Let's talk about safety. I had a question the other day inquiring whether I thought that the government would ever default, the US government I'm talking about. My opinion on that is no. Of course, never say never, but Treasury bills are considered to be the risk-free rate, Treasury bills, notes, and bonds. So realize that these are backed by the US government and are considered to be extremely safe. In fact, when we get to risk, I put here risk-free in quotation marks, again, because nothing is 100% perfect, but this is considered the standard when it comes to risk. Minimum balance. You need to have at least $100 to purchase a Treasury bill. I say at least 100, but that's not quite true because Treasury bills are actually sold at a discount. So right now, if you purchase a $100 Treasury bill, you might pay $99.93 for one. Let's talk about access. That's going to require a broker-dealer. If for some reason you had to access these funds, you won't be able to do it right away. You're going to use a broker or a dealer, someone who can sell your Treasury bill. If you have your Treasury bill at Treasury Direct, you'll need to transfer that Treasury bill to a broker-dealer who can then sell your Treasury bill. Realize that as interest rates have gone up, any Treasury bills that are older have actually lost value. What do I mean by that? Because the interest rates on Treasury bills really are at a max. If you had a Treasury bill, say a 52-week Treasury bill that you purchased in December last year, it is not going to have the same yield. And in order for the person who buys your Treasury bill to get current yields, you're going to have to lower the price of your Treasury bill. So realize that in an emergency, you may be selling at a loss. Now, money market accounts are very similar in some respects to high yield savings accounts. And in fact, the two of them are getting a little bit difficult to distinguish because there are some high yield savings accounts that offer checking, while there are some money market accounts that do not offer checking. But in the past, the difference was that a money market account included checking. Now, realize that a money market account is not necessarily a savings account. It is an investment tool. It's just investing in very safe things like Treasury bills. You can get a fantastic rate on a money market account, 5.25% at UFB Direct, or you can get a terrible rate, such as 0.05% at Penn Fed. So you definitely want to check in to the interest rate. In my opinion, if you're earning anything less than 4%, you're being ripped off. Let's talk about liquidity. Generally, this is pretty instant. You can access funds at most places by checking or a debit card or even an online transfer. Let's talk about safety. Most of these are FDIC or NCUA insured. You will want to make sure that your money market account is at an FDIC or NCUA insured institution. Risk, if your money is insured, your risk is very low. And realize, as I said earlier, that it's highly rated short-term debt that these are investing in. Let's talk about minimum balances. Similar to a high-yield savings account, you may be able to have, well, not quite zero, but say $1 or $2,500 to get an account open. There also may be fees should you dip below that minimum. So those are my three favorite places for emergency funds, and I actually use all three of them. I like my high yield savings account. I like that it's removed from all my other finances, and I can't just simply tap those funds quickly. It requires me to do some money transfer, taking 1 to 3 days. Treasury bills. I really like the yield on Treasury bills. I don't plan to actually ever sell my Treasury bills, so I have been using 4-week, 8-week Treasury bills when it comes to using that as emergency fund. Money market account. I have a local money market account so that I can go down to that particular banking institution and actually get cash when I want to have cash. So I like using all three. I hope this was helpful for you. Please give us a thumbs up. Don't forget to do that. We need that for the YouTube algorithm. And as always, until next time, enjoy your investing.